Hey everyone, it's Jason here from the Bondy-Sawyer real estate team. On July 1st, new CMHC rules for insured mortgages are coming into play, and these changes could make it more difficult for some buyers to qualify for a mortgage. Now, like most of you, I read the headlines, but I wanted to dig a little deeper and get some insight into what the new rules will actually look like. So I phoned up a mortgage broker I know, Tom Miocevich from Dominion Lending, and we had the following conversation. Hope you enjoy it. Hey Tom, how's it going?
Hey, Jason, doing well, thanks. Thanks for having me on.
Yeah, thanks for making the time. I thought it would be a good idea for us to maybe have a chat and run through the mortgage changes that are going to be coming into effect soon. When it was first announced on June 4th, the very next day I had some conversations with clients who were concerned, frankly, about whether or not this is going to affect their upcoming purchase. So I thought you could walk us through the changes, maybe going into a bit more detail than just the major bullet points so that there's more clarity for anyone who needs it. Okay, I thought we'd start this way. Since the new rules are only going to apply to insured mortgages, why don't you just do a quick explanation of what an insured mortgage is?
Anybody that puts less than 20% down requires their mortgage to be insured. So the insurance is for default. So if you were to default on your mortgage, that the lending institution isn't on the hook for your mortgage amount. Because in order to get a mortgage from a bank, you need to have at least 20%. If you don't, then you need to have it insured. So look at the insurer as kind of being like that cosigner, that they're helping you with that down payment to bring it up to 20%, or at least help you get approved for a mortgage of less than 20% because now the insurer is backing you up to the bank.
Now, the changes take place on July 1st. So what about someone who bought prior to July 1st and the closing is after July 1st? What's going to happen there?
So any applications prior to July 1st still use the old guidelines from CMHC. So if you purchased, let's say next week, before July 1st, and you have a closing date within 120 days, say 4 months, then so July, August, so come October, let's say close on October the 15th. So as long as you have that application in before July 1st, you are still deemed by these old rules.
Okay, so let's talk about the first change. The first change basically says that the amount of debt a buyer is allowed to take on is going to be reduced. So before the change, buyers are allowed to spend up to 39% of their gross income on housing. After the change, buyers are only going to be allowed to spend up to 35% of their gross income on housing. So Tom, what qualifies as housing?
Mortgage payment, property taxes, home insurance, utilities, and say condo fees. These are all costs associated with carrying a mortgage.
Okay, and how do they calculate that?
They take your mortgage payment based on a 4.94% amortized over 25 years.
And why are you using those numbers specifically? So interest rate at 4.94, amortized over 25 years.
Mortgage payments would be based on the stress test rate at 4.94%. So it doesn't necessarily mean that's the interest rate that you will get, but the government wants to make sure that you can qualify for a mortgage if interest rates were at a higher rate at, let's say, 4.94%. So in the event that if the mortgage comes up for renewal and interest rates are up, the government just wants to make sure that those people that own that property can still afford it.
Okay, so they take the stress test rate of 4.94 and then?
And they also take $100 for utilities. And if someone's looking for a purchase of a condo, the condo would have a maintenance fee or a condo fee. And for application purposes, we would only include 50% of the maintenance fee. So if the maintenance fee was, say, $600, in our calculation, we would only include $300. So to give you an example, if you're making, say, $120,000 a year, now that's gross, so pre-tax, or say $10,000 a month. Currently, right now, no more than 39% of your gross income can go towards your mortgage payment based on that stress test, your property taxes, the utilities, which we use $100 for, and the half of the condo fees. So again, if you're making $10,000 a month, that means no more than $3,900, so $3,900 can be allocated towards the mortgage payments. Again, based on that 4.94%, property taxes, utilities, and condo fees. With that being said, someone who is making $10,000 a month can afford a mortgage of $585,000, of which $3,382 is the payment based on, again, the stress test at 4.94, 25-year amortization. So if you had an interest rate for a 4.94% and you can pay it back over 25 years, which is the amortization, if you paid $3,382, then the mortgage would be paid off in 25 years. So that's basically what that means. So $3,382 based on the stress test. And if let's say the property taxes were $2,400 a year, so $200 a month. And let's say they're purchasing a condo with a $600 maintenance fee. So now we're only using $300. So if I take the $3,382 and I add the $200 and the $300, that's coming in just shy of $3,900, which is just shy of 39% of that $10,000 a month that they're making.
So what's happening to these numbers after the rule changes take place?
So after the rule changes, they want to reduce that debt servicing from 39% to 35%. So with the same example as before, now you can only have $3,500 of your $10,000 a month income that can go towards your mortgage payment, property taxes, utilities, and if it's a condo, half the condo fees.
And how does this change affect actual purchasing power?
So with this situation, the most someone can afford if making $10,000 a month is the $510,000 mortgage. So that's down from $585,000 mortgage to $510,000. Now let's not get confused between purchase price and mortgage amount. Yeah. We're just talking the mortgage amount. So if someone had, say, $100,000 to put down, then the purchase price would be $610,000 or $685,000, right? From the $585,000 from the $510,000. So you can see that there's definitely a decrease in the amount that someone can afford.
Now, there's another number that's going to be changing as well.
There's another debt servicing requirement, what we call total debt service ratio.
Yeah, so that one includes, it's everything we just talked about, plus other loans.
Correct. So if you have a credit card with a balance on it, if you have a car loan. So because someone might have additional expenses, as of today, so before July 1st, you can have up to 44% allocated towards now that mortgage payment, that property tax, that condo fee, and also now, let's say, a car loan of $500. That's why the ratio is a little bit higher at 44% versus the 39% as of today.
Right. And then after the change, that 44% is going down to 42%. So can you talk a bit about how the total debt service ratio is calculated? I mean, in other words, how do they look at whatever loans a buyer might have?
With credit cards, you can have a $20,000 credit card with a zero balance. And if that's the case, we do not include any debt, any loans or repayment. But let's say, for instance, in this example, a person has a $20,000 credit card with the balance being at $20,000. Even though their payment would be maybe an interest portion or it might be a set payment, all the lenders look at credit card payments at a minimum of 3% of the balance. So if you owe $20,000, 3% is $600. So that $600 we have to include as a monthly liability.
Yeah, so even if your payment is less than that, if your payment, like you said, is maybe $300 a month, it's interest only, Doesn't matter. They're counting it as $600 a month.
They're called counting it at 3%. Now, for the loans, for example, if you have a car loan and you're paying $450 a month and the car loan's $50,000, they don't take the 3%. They actually just take the loan payment.
Yeah.
So whenever you have a revolving credit facility, so revolving meaning credit card lines of credit, then they take 3% of the outstanding balance, not the limit. If the limit is $20,000 and you have a zero balance, then there's no payment. If you have a credit card with a $20,000 limit but a $10,000 balance, then 3% of $10,000 is $300, and now that $300 we have to add to that equation. So back to the example of $20,000, and let's say $20,000 is being utilized. So we're now adding $600 per month. So the debt servicing ratio, based on the same payment as before, we're now adding that extra $600 to that $3,400, which we were paying before with the new stress test. So if we added $600 more on top of that, that brings us to 39. So that brings us below still that 44% threshold.
So Tom, here's a question. In your opinion, which of the two ratios is more important?
So the total debt service ratio isn't as important, in my opinion, as the gross debt service ratio. So, and the reason for that is because if the applicants don't owe any money to credit cards or loans, then the maximum is still 39%. It's not that 44% that you would get that benefit of if you had other debts.
Okay, so we've covered debt, and the next change has to do with credit scores.
Before the rule change, at least one buyer was required to have a minimum credit score of 600, which is pretty gracious. 600 from past experience would mean late credit card payments, maybe a credit card that was closed by the credit facility or by a credit grantor or collection agent. So 600 in the past was pretty aggressive for the insurers. Whereas now, after July 1st, CMHC requires a credit score of 680 or more. So 680, again, from my past experience, is someone that has a good credit score. So, they made their payments on time, and maybe their credit score is a little bit lower because they have a $10,000 credit card and 9,500 of it is fully utilized. Or they've got 2 or 3 different credit cards and all of their credit cards have been paid on time, but they're all at that maximum. They're all being close to being maxed out.
The rule says at least one buyer must have a minimum credit score. So, if a couple's buying a house and they're both on the mortgage, but one of the couple has a poor credit score or fair or whatever, as long as one of them achieves that minimum of 680.
Well, that's sort of right, but if the main income earner is over 680, then they will carry for both. There will be exceptions, and there has been exceptions made in the past where the main income earner has a credit score of less than before it was 600, and the second applicant had a better credit score, let's say 750, but made less money. Let's say they made half the income that the first applicant did. If that's the case, we might get a little pushback from the insurer. Usually, the person that has the higher credit score should also have the higher income. Now, if we're at a 50-50 split, then it wouldn't matter. Like if one couple out of a couple is making, let's say, $200,000 a year, one is making $100,000, the other one is making $100,000, then yeah, at least one would have to have a credit score above 680. But that doesn't mean that the second applicant can have a credit score of 400 or 450. They still would have to have a credit score above 600.
Okay, so we've covered debt, we've covered credit scores. Now, the last change has to do with using borrowed money for down payments.
I've had a lot of people call me up and say, I never knew I actually could borrow money for a down payment. Well, you could, but it wasn't necessarily always approved. Usually this program was available to, young professionals, people that have just finished, school, just paid off their student debt, and maybe they didn't have the savings because they were paying off schooling, but are now in an industry that they're, making a lot of money and potentially going to be making more money in the future. So in a situation like this, as long as the applicant can borrow the down payment from a line of credit or a loan or a credit card, even from a cash advance, and again, as long as we can put in that 3% as part of their liability of what they're borrowing, and then their debt servicing ratios are still within the 44 and 39%, then that applicant would be able to borrow money for their down payment. So to give you an example, let's say someone purchased for $500,000 and they didn't have any money for the down payment, but they were making, $150,000 a year just out of university. Maybe they just finished their, master's or something, and they've got a high-paying job. But they spent all their money on school loans and paying off student debt, but they want to buy a place for $500,000. So they would apply for a loan or a line of credit for $25,000. And if we take the balance of $25,000 at 3%, works out to $750. So when we start adding up all their costs, so their mortgage payment at the stress test. So again, if we look back at the first example, if someone was making $120,000 a year and then $10,000 a month, so that means no more than $3,900, which is that 39% can be allocated towards the mortgage. And then we had that 44%, which included the loans. So now we add $3,900 plus the $200 a month for the taxes. Again, if they were purchasing a condo, we would add the $300, and now we would add that extra $750. So as long as that amount works out to less than $4,400 a month, or 44% of the $10,000 a month that they make, then they would qualify. So under these new rules, now what CMHC is saying that they're eliminating that altogether. So if you don't have the savings for a down payment, that you are no longer allowed to borrow it from a line of credit or loan, even though you can more than qualify to take on an additional loan to use as a down payment. Even if you're making $300,000 a year and only want to purchase a property for $500,000, and you could borrow $50,000 and still your debt servicing ratios being in line with that new debt, as of July 1st, CMHC will not allow that.
We should point out here that CMHC is not the only insurer. There are two others, right?
Genworth and Canada Guarantee. They are funded privately, whereas CMHC is funded through us taxpayers. It's a government-run organization. But we do have two other options and two other insurers that we can use that are not CMHC, and they are Genworth Financial and Canada Guarantee. So after CMHC made the announcement on June 4th, it was just as much of a surprise to the other insurers as it was to people seeking for insured mortgages. So the day after, they came back with an announcement saying that they are not going to follow suit with CMHC's guidelines. So going forward, the debt servicing calculations of 44% for total debt service, which includes your mortgage payments, property taxes, condo fees, and any other loans, and the gross debt service ratio at 39%, which is everything except for additional loans or credit cards. So they are still going to be using the old guidelines at 39 and 44%, which is good news, because if you remember from my previous example where someone was could afford a $585,000 mortgage if they were making $120,000 a year down to $510,000. That's quite the jump. So there is light at the end of the tunnel in the sense that we still have insurers that will still approve that applicant up to that $585,000, even though CMHC is changing their guidelines. So the insurers also came back, and not only did they say that they weren't going to change the debt servicing calculations, but they will also allow for your minimum credit score to be 600, and it's not jumping up to 680 like CMHC. And they're also still allowing for people to borrow money for their down payment should they be able to qualify with the new monthly debt that's occurred with that loan. So as much as it sounds scary to a lot of people thinking that, I thought before I was out of the market, and now with these new changes from CMHC, I'm definitely out of the market. We do have these two other insurers that are stepping in to help, Canadians fulfill their dreams of home ownership and keeping things the way they are. So in essence, really things haven't changed for buyers because they can still qualify using the old rules. But who's to say what's going to happen in the future? That if there's too much share being transferred over from CMHC to Genworth or to Canada Guarantee, that they could very well come back for the next couple months saying that they're going to change their rules as well. But as of today, which means that as of July 1st, you still want to buy and still be approved by the old rules, we can still get you approved that way.
Tom, thanks so much for all this great information. I know it's going to be enlightening for some people and reassuring to hear. They read the headlines, they make an assumption that maybe this is going to take them out of the market. But from what you're saying, that's not the case. People are potentially going to have other options. So it's great to hear that.
I'm glad for the two other insurers that are sticking to the old ways, because if we did change our debt servicing calculations and all these other rules for the credit scores and the borrowed down payment, again, I think that there would be a lot of people that would love to be homeowners that could not be. So kudos to the other insurers for sticking with the old rules, and we're always here to help people qualify and see how much they qualify for. That's pretty much it.
Tom, thanks again for hopping on the call. Really appreciate it.
Great. Thanks, Jason.
Okay. Talk to you later.
Talk to you soon. Thanks.